This is the Flexible Office Economy, and I'm Mark Gilbreath. This week, we're talking about corporate co-working and how to scale a space franchise. My guest today is John Arenas, the chairman and CEO of Serendipity Labs Co-working. John founded Serendipity Labs in 2011. Welcome, John, and thank you for joining us today on the Flexible Office Economy.
Hey, Mark. Great. That's so great to be with you. Thanks.
So, John, I've known you for a long time. I've had the pleasure of knowing you for a long time. And one thing I know is that you've uniquely invested an enormous amount of career capital into the flexible office industry. You've started 3 companies over 20 years. Why does this industry have such a hold on you as a professional?
Well, that's a great question. I think it's partly just the belief that there's a better way to do something that's been done, I would say, in a archaic way for decades and centuries almost. And we've been evangelizing the future of work and trying to make it all happen for a while. And I think it's finally here in this kind of maybe third iteration of workplace as a service.
There's been talk of the future of work for 20 plus years. Do you think is the future now? Are we upon it now?
I think we are. I mean, as someone who started out, I'd say in the 1990s with a shared workplace, which we would then call executive suites, with this vision that if you could build a network of locations, you could allow people to traverse that and solve some urban planning issues and serve some quality of life issues. It was really intriguing to me, and having built businesses in the category, and even built a business really that was more online with Worktopia, which is a marketplace for securing workplaces back in kind of pre-mobile app. Really was a lot of evangelizing and selling this idea of the future of work. And what's happened in the last 36 months or so, maybe even less in some ways, is a tipping point's been reached in 3 really critical areas. One is the true consumerization of work, where people feel that they know what they want and know what to ask for as an individual, how they want to work. Companies having experienced the freedom of being able to choose flexible options instead of long-term conventional leases, which make almost no sense for most of their footprint. And then third, which was always missing back in the day, was collaboration with landlords and asset owners who were always bound by the way that their assets were financed and underwritten, and that's freed up. So I think all those 3 things together have delivered a new era, and now it's this opportunity to express ourselves with products and services, and there's lots of room for solutions and lots of room for investment to solve these problems, because co-working isn't just one thing, flexible workplace isn't just one thing, and there are only a handful of brands out there that are, we'll say, institutionally financed and organized. And so we feel lucky to be at the beginning again.
You described it as a third iteration or a third phase. I sort of share that point of view. There's so much derivative experimentation going on now. Landlords getting involved, as you know, multiple flavors of co-working, the continued scaling of serviced offices or executive suites, and further derivatives therein. What are you most curious about here in this third phase? I mean, personally, what are the most interesting elements that you find that are drawing your attention as you drive Serendipity Labs?
Again, there are all these different products and services that people refer to as co-working or flexible office. And what I'm most interested in is really maybe my love for urban planning and systems and transportation and kind of the bigger picture of all of this, where it's more around how do we deliver the substitute for just physical built infrastructure as a solution, a place, and allowing people to traverse that. I used to like to use the word urbanot, because people are traversing that network of resources. Some are virtual, some are real. And to me, that is actually possible now because the demand is being driven by large organizations, companies, corporate occupiers, who are trying to outsource functions that couldn't be outsourced before because everything was proprietary. All their technology was proprietary, their access control, their systems, their policies, their change control. Everything was so compliance-driven that they couldn't do it. But now with the enablement that comes from technology, we're able to emulate those workplaces. And so it's not just space, which I think we sometimes get, well, not we, Serendipity Labs, but we as industry get lumped into this space type of definition. But really what we are is we're create a bunch of settings that are appropriate to different kinds of work. And so being able to create a collection of settings that someone can traverse is really the interesting thing to me. And so that microcosm of that is, for instance, isn't just workplace that is a dedicated desk or dedicated offices. It's actually a club. It's actually a meeting and event venue. And those are the activities that companies need to support, but can't really do themselves, particularly in remote markets, suburbs, secondary markets, and sometimes even in, near their headquarters. Being able to emulate the corporate requirements closely enough that you can truly be an outsourced vendor requires network and platform and other compliance competencies. And that's what's interesting. That's what's kind of always been different about us. I'm not sure that anybody else has really approached it that way. A lot have approached it from signing leases and operating locations and growing a network or growing more locations, but really having a platform, I think, distinguishes 2 or 3 operators out there.
I hear a lot of consideration of the user experience when you talk about the consumerization, and when you talk about freedom. I'm a corporate employee, and I've been given the freedom to go and exercise some choice. And then furthermore, when you talk about a collection of settings, all of those sort of descriptors suggest a very dynamic user and a user who's sort of intrinsically mobile. How mobile do you see the future of work being versus assigned or persistent at an office? And I suppose with that, what are you seeing in Serendipity Labs' business today in terms of the mobile and more dynamic or temporal use of your settings versus committed in longer term?
Right. Well, it's a kind of interesting because in a way, co-working started out as a kind of a creative collectivist camp, people trying to get together and work in ways that were more convenient around people that were doing kind of similar things as they were doing. And that somehow got lost along the way and with some of the larger networks, in that it became a space rental business again. And, it might be a fancier or, more glamorous kind of setting, but it's still the room rental business if you don't create these other elements, which create community, create social interaction, create, because of our name, of course, serendipitous opportunities. And a community doesn't have to be defined by an age cohort or an industry. It can be defined by a stage of life that is maybe more geared towards a professional worker. So I guess what I'm getting at is that people are actually, if you can create a network and create an ability to traverse that network, which you've been a pioneer in, trying to find that way to allow people to have a trusted experience and go from place to place. If you build a big enough network of outsourced settings, we'll call them, then there's really less and less need for corporate employees in particular to have a dedicated assigned space. I will say that probably around 5 years ago, the corporate occupiers that we were talking to about how to build the perfect brand for them were just reinventing their own workplaces. They were just at the point where they were trying to test mobile workforce policy and program, test unassigned desk, test, going to allowing you to use your own phone or your own device was actually a big deal. So now they are in a mode of saying, we tested it, we've trained our own workforce knows how to work this way. We just need more inventory. We need more places to go. And so being that set of places is again what we're seeing free up. So as our membership and our revenue of our company and our locations is skewed to around 30% is stuff other than a room rental. So it's the club business, it's co-working, it's a drop-in transient membership, to put it in travel terms. And it's also club because it's groups of people that make our location their clubhouse, for whether it's tech moms or it's a young professionals organization, whatever it is. It's a platform for them that is exclusive. It's really, again, it's kind of a canvas for them.
John, one of the perhaps more controversial topics, or topics I hear debated a bit, is whether that corporate user, in choosing a co-working space or a co-working network, is choosing to outsource just the settings to facilitate work, or whether they are outsourcing some of the culture enhancement or culture creation or culture shaping. What's your view of the role of a co-working space in terms of being an influencer of the culture of the company versus a place?
Right. Well, I think you can have your own, you can be a canvas and a platform without having to I would say, dictate a culture, being, I would say, neutral and supportive of other company cultures and allowing them to express themselves, which they naturally will do anyway, is important. And I think companies really are concerned. You say it's controversial, but I would say, some companies believe they have a culture, but maybe their employees don't know what it is what they're really trying to hold on to. So I don't think really co-working diminishes that at all. I think we all are, in effect, gig workers anyway, and I think companies have come to grips with that, in that people are going to choose to align with the values and the culture of an organization, and also hope to be supported in their workplace, if it's co-working, for instance, or shared workplace, in a place that also respects those same values. So I think you can have an alignment of values that is maybe more attuned to corporate sensitivity, confidentiality, business acumen, security, safety, duty of care, policy around the workplace, managing the workplace and sexual harassment or hostile workplace. Just having a solution provider or workplace provider that is attuned to those things allows for that culture to flourish, whatever that culture is. So I don't think it's up to our industry to create a culture for a company. I've never had a company ask us to do that, or in fact, some of them, I would say, probably resent the idea that they need to be given an infusion of cultural values.
Yeah, because there are some operators out there who are first and foremost promoting their community, like their branded community. You're a member of their community. For the corporate customer, do you think that that's more than is expected, or even more than is desired?
Well, I think it's maybe superfluous,
Yeah.
and to the extent that doesn't interfere with the culture of the company. But I do think that when you're trying to create a very specific culture for a co-working operation, that is done not just in the colors and the furniture and how you greet someone. It's done in the programming of events, and how, what your standard, kind of your operating procedures are, and your attendance to safety and security. I think so. I don't think that is something that companies are asking for. I think it is something that makes it exciting when you're trying to promote your brand to investors and to generate excitement. But I think more often than not, we're certainly hearing that having brand appropriate, culture appropriate events and programming and service standards is more important than maybe infusing a sense of youthfulness or something into the work experience.
So in 2000, or probably back in the 90s, you founded a serviced office chain called Stratus. 1995? When was that, John?
Yeah, 96. We started in 96. I started operating a first shared workplace in 1992. I was working for a company that just so happened to be in the real estate business and was doing that. I discovered that there was an entire industry, mostly, this would be, I guess, before 1.0, what's before the beta of co-working, and it was really born of secretarial service and executive suite, which used to be called this thing called Keyman offices, but I don't think you can really even say that anymore. But anyway, that's what it was. And yeah, so ultimately, a few years later, started to build a company. A company-owned and franchise locations called Stratus Business Centers, grew it into 11 states, a couple of dozen locations with another couple of dozen on the way. And that was right when Regis was coming to the US and going for an IPO. And so they ended up acquiring.
So that acquisition or that sell to Regis, was that opportunistic or planful? Had you contemplated an exit and built Stratus with that in mind? Or was it?
Well, I think as markets form up, strategies develop, and we saw that they were coming into big city centers with the world-class trophy assets. And we decided that because of their capital structure versus ours, which is franchise and really, kind of a lighter capital model, we chose to focus on secondary markets and suburbs, and learned how to be successful in those markets. And what it turned out to be was, for those people of a certain age now, kind of chocolate and peanut butter. It just actually made sense together, and we weren't really in their way. We were additive and complementary, and it was just a very natural combination. We did believe, and it turned out to be true ultimately after after a few bumps and bruises, that having that access to a platform, to a true, even then, enterprise sales capability, that marketing power really made the difference for our franchisees and our locations in the suburbs, because they had access to business that they never would have had access to with a small regional network or East Coast network, which is what we were.
Well understood. I think that Regis established a pretty strong and in-depth penetration of the enterprise market, and they leverage their scale, of course, to do so. In describing Serendipity Labs presently, you talk about having to meeting the same rigorous standards of safety and security that corporates have within their own portfolios. Does this mean anything different today than it did to an enterprise customer for Stratus or Regis back in 2001?
It's a big difference, actually. Back then, the use case for shared suites or executive suites or that kind of shared workplace was to reach into a market, to put resources around one or two or a very small handful of executives that emulated the corporate workplace and provided a sense of credibility, because back then it was about image, and now today everything's transparent. So the value proposition was for large organizations to be able to have flexibility to support an individual. What's changed is that because the product has changed and because of the things I was talking about earlier, the large forces that have moved, the offerings can now satisfy large requirements, larger, but I don't mean just in one location, like square feet in a location or people in a location, but a large requirement like a strategy of improving, supporting workplace mobility, or a strategy of supporting business continuity. Those are bigger issues that large corporates really couldn't use the old executive suite design product for. And frankly, they weren't really ready to, because everything was central command and control down to, you had two phones because or you didn't have any phones, actually. So you did have any phones.
What are the so contrast for our listeners? What are the market differences between a Serendipity Lab 2019 physically, spatially, and a Stratus 1999?
Oh, sure. So Stratus 1999, there's actually an operator out there in the world today that's doing kind of what was Stratus, which is call it 10 or 12,000 square foot individual 10 by 12 offices with narrow hallways and a receptionist out front. I mean, that is a business, and it's a business that is doing fine as far as I can tell today. That market was also geared towards self-employed professionals, startups to the extent there was such a thing, and freelancers. So the credit quality was very different. Today, flash forward, we have a set of solutions and really workplace settings that are solving kind of in each location, solving different needs. Corporate teams that are regional and local still needing a place to meet and get together for ideation or generative meetings, planning retreats, and that sort of thing, to be able to support a mobile workforce and have a drop-in place that you're secure and you're on the VPN without signing up every time and trying to log in. You automatically log in. So we're basically creating, and of course, team rooms and project space and all of that. So what we've done is we've created one big co-working facility that just happens to have lots of nodes on that network. And so, for instance, a Serendipity Labs member today, when they walk into a location with their laptop or their phone, if they've been enrolled in our network, they're already logged into their VPN. They're already logged into the systems. We can measure activity and presence and all kinds of things, down to going through an elevator turnstile and the elevator coming to you and knowing what floor to take you to. And that's already stuff we do today. And that's because that's what companies expect.
Yeah. So again, comparing, how would the actual densities on a given day basis in terms of people per square foot compare Stratus versus Serendipity Labs today?
Yeah, and that's kind of interesting because that's actually kind of the same. I mean, you might expect it's different, and the type of worker was the same. It was still a trusted knowledge worker. At Serendipity Labs, I get my companies mixed up, too many companies, but it's Stratus and it's Serendipity Labs. But certainly at Serendipity Labs, our average member, the range of membership age is 30 to 49. It constitutes 75% of our members, and 36% are women. That's different. Certainly, it was much lower percentage of women back then. But the density, which we kind of measure and we call mean peak census, which is this idea of what's the most people that are there at any given time at the peak times of the week, really is a lot like what corporate occupiers experience in their own facilities, because our members are trusted knowledge workers. They travel, they're out with customers. And so we don't have the small desks and lots of shoulder to shoulder workers. We really have, when we do have teams, everyone has a different function. There's a business development person, a salesperson, a local sales manager, and they're out and about. So it's a bit more, we kind of refer to it sometimes as serene vibrancy. It's not that club beat, but it is, people, it's a welcoming kind of environment because it's not a dense packed, hyperactive environment.
I like that term, John, serene vibrancy. That's good. That captures it. You've written in the past about the potential for an office apocalypse, and you cited the retail asset implosion of recent years as possible analog to that. What's your outlook today? Should commercial office investors be running for cover?
Well, I think, what I've written about in the past was something around kind of the change in buying behavior and the change of expectation from kind of shopping a traditional way in retail to shopping online. A movement of about 5% of that behavior has drastically changed how real estate is used and how the shopping experience is offered. And that, witness, entire malls, 25% of malls are supposed to close within the next 5 years. Maybe it's 4 years now because it's been a year since I wrote that. Yeah. And Credit Suisse came up with those numbers. But the same kind of thing could leave landlords behind if they're not understanding, appreciating, and moving towards creating new ways of delivering the workplace experience. And some of the most advanced landlords are also the most, I would say, constrained because they have more traditional capital. The capital, the way they're financing their assets, and those are being underwritten up until very recently, has looked askance at coworking, not really understanding it and not really understanding the value of it. Where we've seen a lot of movement is in the entrepreneurial kind of mid-size asset owner that has got maybe more creative financing in place and can do the things. So they were really the first to move. So I would say if you stand still, then yes, the earth is definitely moving under the feet of landlords right now, and they're trying to figure out how to be relevant, how to deliver the right service. There was a time, I would say most of the time frame we've been talking about, the last 20 years, where we would have to work very hard to convince a landlord to take us on as a tenant. Today, we can aggregate better credit on a floor than they can in a lot of cases, particularly in secondary markets and suburbs, which is a huge advantage. If you think, I'll give you an example, Charleston, South Carolina, 80% of lease transactions are for under 10,000 square feet in that market. You can imagine that if you're, going to stand still, and Serendipity Labs is coming to town, which we're doing 2 locations there, by the way, that you're going to have to think about being able to compete with something that's a much superior service that ultimately gets delivered at a lower cost when one considers all the factors, including whether or not how long you need a space and how many employees you'll have, all those good things. So yeah, so that's from an apocalypse point of view. I think it's more or less the shift is starting. It's a huge magnitude. There are studies certainly that show, I don't know if they show, but they certainly would indicate that this could be 30 or 40% of the market being flexible. I would, maybe because I've been at it for as long as I have, I would say that going from 1.5% to 3% is a pretty big move, which is what's recently happened. I would say going to 6%, doubling again to 6% is certainly viable, and maybe even 12% as a third party, kind of business of operating workplace, call it meeting, event, and shared workplace. I think a lot of the rest of it is that tail of that other 30%, maybe that tail is more landlords doing something that's more familiar to them, which is maybe slightly serviced office, or maybe companies also being in that mix of managing their own or having third parties manage their flexible portion of their own footprint. So it's all definitional, like I said at the top of the conversation here. It depends on how you define co-working or flexible office. You can any number you want.
You got some background in hospitality before you got explicitly involved in office. How realistic do you think it is for the capital markets to adapt their underwriting approach for flexible office as a category? I mean, as they have in hospitality, as they have in multifamily and in retail. Can that happen? Do you think, is it inevitable?
It is happening. I mean, I would say anecdotal evidence of that, but certainly Morningstar research came out last year with a guidance on how to underwrite CMBS-backed office space and how shared workplace was not an if but a when, and you have to figure out how to deal with it because it's going to be in your portfolio. So now maybe they may not have expected as much as they got, but that was a year and a half ago. But that is happening. I also would say that the evidence of that is that landlords, asset owners who are sophisticated are looking at, they have terms now like, how are we co-worked? Are we under co-worked or over co-worked? We don't want to encumber this asset with an exclusivity that says we can only have this one co-working operator for 30,000 feet or 20,000 feet, because that may encumber the value of our asset. So we don't want to do that. We think maybe multiple brands could go in the same building. So the fact that they're able to think about that and are already making sure they have the optionality to add more co-working tells me that the financing sources are warming up to it. Now there's still some of the very, depends again how the financing is put together for the buildings, but that's definitely happening. And we are also seeing a lot of programming into new projects where we're getting in conversations 2-3 years ahead of projects being entitled, and they're already programming, putting out an RFP or interviewing co-working companies. So I would say that institutional financing is catching up, and once that happens, you'll see more than just the asset prediction warning here. You'll see more than just the asset itself being valued differently because of the cash flows that can of the operator. Just like a hotel asset gets valued based on the brand or flag that it can support, it's going to be the same way if the brand of co-working that you have will be kind of a proxy for the credit quality that it's aggregating. And as far as the prediction alert, I think that aggregation of those, call it member service agreements and contracts, is not very unlike at all the aggregation of housing rental contracts. And so we have explored and been interested in, mostly out of curiosity, I'll say, kind of plans of some sophisticated financing market experts who are looking to aggregate contracts within co-working and to offer them as a security. So that in itself is really kind of flashing forward past even hotels into almost like the housing rental business that got aggregated and rolled up and bought by Starwood and Blackstone and all of that.
Yeah,
that's kind of exciting. So we always have something to look forward to, which is good because now that the future's here, I don't want it to get boring.
No, it's a very exciting notion. Yeah, I've pondered that as well. The notion of a virtual asset class, a layer of multiple buildings being securitized. Very tantalizing. So Serendipity Labs, 34 locations open today, or something of that order, across 19 states. So you've in less time, you've already surpassed the scale of Stratus, and I think you've got upwards of 100 or more in pipeline, if I'm not mistaken.
That's right. Yeah.
What's the most binding constraint as you scale Serendipity Labs today?
Well, I think, we certainly invested early in our platform and our capability to scale, not just scale by being able to open locations quickly, on time, for the right cost with a global supply chain, which is something to do, but also to be able to fill them with a kind of centralized sales set of channels that plug into the high quality opportunities for, so that if you can't really grow without that, otherwise you're just opening, signing leases, opening locations, and hoping for the best. And Google AdWords and meetings and event and sponsored meetings in the evenings can only get you so much business. Although that's a good source, that's not a way to build a network. So our view is that if we are the brand and we are generating with our platform, we are generating, pure play master service agreement relationships direct with corporate occupiers that want to use the entire network, that's the investment that was constraining. And so normally the other constraint would be capital, but because of our structure We're growing through managed licenses with landlords and managed and franchise with hospitality operators who are also franchisees of Marriott, Hilton. I guess Marriott is also Starwood today, but so they're experienced operators who have capital, they have a team, they've developed in that market. So they're giving us access to markets, to really own markets like Indianapolis and Columbus and others that otherwise it would be very difficult for institutional capital to take us there. So we're unconstrained by capital. We've raised indirectly about $200 million to build our network by our partners and development partners, franchise partners, and management partners. So we've only really had to raise to this point about $30 million to build our network and to get the flywheel moving. So what this does, the constraint is really now having end-to-end systems and process for everything, which we feel like we do. To give you an example, our enterprise sales team can use their mobile phone and check inventory pricing and corporate pricing and discounts, preferred pricing for a corporate account name on their phone, and check availability across any location or network, and when it does become available. So that kind of visibility on your inventory and pricing efficiency means that you can actually have throughput. It's not making a phone call and asking if somebody has availability. So those kinds of systems end to end were a huge investment, and that's really what was constraining. And we like to think that we're leaping ahead, and we opened 4 locations last month. That would be a good pace to be on.
Indeed. Speaking of scaling strategies, you were a party to one of Regis's scaling strategies, that being of acquisition. And I don't know what you probably do, but I don't know what percentage of Regis's 3,000 plus locations came by acquisition, but there certainly were hundreds that did. Do you think the co-working industry is entering a period of increased acquisition? Because it doesn't seem that that has yet happened in the same way that serviced office chains were absorbed by Regis and HT.
Right. Yeah, I think what you're referring to is certainly in the early 2000s or mid 2000s. There was a lot of consolidation. There were a couple of roll-ups that rolled up together, and then they then got acquired by Regis, and so that was the massive roll-up that kind of got it to about 800 locations in the U.S. So that's a little bit of the genesis of that. I think there in that situation there was a buyer, in a lot of ways a single buyer, and so downturns tend to be an opportunity to buy EBITDA. There's never really a reason to buy revenue, and I think that's kind of where we are in this industry right now. Is that there's not a lot to buy. I mean, not that we're looking to buy, but I would say that there's not a lot to buy that would be accretive. And I think and also, so there's that aspect of it. And then on the other side of it, are there buyers? And I would say that there are there are only 4 or 5 national networks of co-working. I would say all but maybe one is capital constrained. It appears to be capital constrained, and I say that because I think that the capital markets were funding co-working on a revenue valuation and on the idea of total addressable market and growth. And today they're valuing them like they should, which is on unit economics, scalability, systems, process management team, and there aren't many of those around. So I think the ability for an organization to acquire also is a competency of an organization that really requires them to be of size and of some stature and some access to capital. But right now, we don't see a market forming up that is going to lend itself to that, which actually maybe takes things from into another direction rather than consolidation by acquisition and roll up into more, I would say, dissolution. I think there are a lot of co-working, independent co-working that have been great experiments and great businesses and great fun, but were built on opportunistic leases that won't be renewed from 10 years ago, that won't be renewed on such terms. And it'll be hard without global supply chain channels for sales, systems and processes to really maintain margins, to get to margin. So I think that's what will happen to them if there are no buyers. But having said that, there are always some good regional operators that that pick some things off here and there, and we see that in every market. There's a good regional operator.
Serendipity Labs has been public with the fact that it's profitable. Congratulations. And it's also quipped that it's not losing $1.5 billion a year.
I think you mean $2 billion.
Yeah, $2 billion. So I assume that's a reference to WeWork. What's your reaction to how they are deploying their capital?
Well, I think it's been, it's of course, when you have a business plan of being big and then figuring it out, which, plays well in technology businesses where there's one winner or one or two winners. That's a strategy that, people follow. And I think once you're an investor in that, you have to also follow that. So you're cheering for that still. And so I think there are definitely some cheerleaders who believe that there might be one winner in the shared workplace business, but it is real estate and it is fragmented. There are a lot of solutions that need they're differentiated, that need to happen. So I don't necessarily believe in that kind of get big and figure it out later strategy. And also it does lend itself to something that I've witnessed before, which is that you can kind of accelerate past a point where you have more locations that are not mature, disproportionately new locations, and not enough mature, solid locations to support you in the event of a shock to the economy. Right. And that is dangerous. That combined with, sorry to keep going, but that combined with this kind of wholesale naked lease arbitrage of full floor, multi-floor and full building deals is, it's a suicide mission.
So John, how will you...
That's my words there? I'm sorry, what?
No, you didn't. There's a clarity of thought there. Much appreciated.
Well, it's an opinion. And having lived through some of those ideas, when I got to Regis, they acquired my company, as we talked about. They had just signed 3 million square feet of leases in a run-up to an IPO and a run-up to what ended up being a dot-com bust and the 9/11. And those multi-floor deals that look really good on the pro forma, because once you fill them out, look how big your valuation is going to be, really ended up, being a millstone.
So how will you define success for Serendipity Labs?
I think, we have a lot of constituencies. We have landlord partners, asset partners, we have franchisees, we have employees, we have investors, and we have, of course, members, and then the companies they work for. So we feel a lot of responsibility for delivering on a lot of promises. I think success is when people look at us and say, hey, they fulfilled that promise and they are who they say they are, and we can trust them to do business with them, and we like doing business with them. I think that's kind of success. I don't think, it's not the number of locations. I think we will probably get to a couple of hundred locations. It's not valuation, revenue, EBITDA. I think it's, I think as you are a serial entrepreneur, you probably, appreciate this too, is that you're really trying to build something of value that answers a bigger question than dollars and cents. And as it started at the top of the call, it really is about, unlocking quality of life, human potential, having an impact on the built landscape. All those things to me are, more interesting and kind of get me up in the morning than what the share price is.
Well, John, you're a very smart guy, and I'm for one outspokenly rooting for your success. So I wish you all the best with Serendipity Labs, and thank you very much for joining us today on the Flexible Office Economy.
It was a great pleasure. I hope we get a chance to do it again sometime soon. Great to see you.
Indeed. Thanks, John.